Hey guys, it's week ahead time, and this week we'll be taking a slightly broader view of the market as a whole with a couple of important observations that we've been highlighting to you guys over the past few sessions in the videos as well as the webinar. So it is a little bit of a longer video than usual, but please stick with me. Important info nonetheless. So let's get started with that. Now, taking a look at risk assets, we've been ripping across the board in risk assets over the past few weeks and months, and that's been due to a culmination of factors, especially more recently. We've had that positive vaccine news, we've had the reduction in all of the uncertainty on the US political side. We also have the overall growth and demand outlook going into 2021, further propping up the markets alongside hopes of additional stimulus both on the US government side as well as on the major central bank side like the Fed as well as the ECB. Now, the rally that we've seen, interestingly enough, hasn't been only limited to something like equities. We've also started to see that steady rise in something like the US 10-year yield, which was just a whisker away from that very important 1% level going back on Friday, alongside, of course, that further jump to the upside in 5-year and 10-year inflation expectations on the US side. Now, is this rally that we're seeing justified right now in terms of risk assets, in terms of the US 10-year, etc., the downside in the dollar? Well, even though the perma bears out there would obviously say no, you have to admit that the current climate that we're in, with things like the narrative for lower for longer rates and the positive vaccine news and the hopes for further stimulus, that overall broad-based expectations of economic recovery in 2021, all of that is hardly negative for the market, and you can expect risk assets to enjoy moves to the upside on the back of that. But we do have a little bit of a balancing act going on right now, because even though that medium-term trend is baked in for the market, the short-term exuberant sentiment that we've seen is a little bit stretched right now, arguably stretched. And even though with the dollar index is hitting 2-year lows, at the same time we're heading almost every other day we're getting all-time highs in something like the S&P. And that in itself doesn't mean that, okay, the market is just going to reverse from here. But if we take a look at various sentiment indicators and positioning, it does mean that we do need to be paying attention in the short term for possible risks. If you take something, for example, like the blue, we have the put-call ratio composite, and that has reached similar levels going back to June 2020 as well as September 2020, and both of them signaled a short-term top in the S&P as well as a short-term bottom in the dollar index. Now, it's very important here to highlight that a short-term top and a short-term bottom doesn't mean a change in the sentiment, a change in the bias. It doesn't mean that, the market is going to go selling the S&P for the next 18 months. It just means that we want to be very careful when we're trading, because we are at frothy levels to the upside for the S&P and very low levels for the dollar index. And that means that even though that medium-term biases is still intact, trying to chase these moves any further, whether to the upside for equities or the downside for the dollar, is looking rather unattractive right now in the short term. Now, it's important here to understand once again that calling for caution with these types of indicators doesn't mean that you're calling for a change in the bias. That's two completely different things. And when we want to contemplate whether the short-term risks for strong trends might be catching a potential wobble, it is a little bit of a balancing act. And the way we do that is basically looking at all the available information, looking at various scenarios, and then looking at the balance of probability. So starting then with seasonals. Seasonals actually point to a further move to the upside for equities and a further move to the downside for the dollar. Looking at these two charts from Seasonality, we can see a strong downtrend visible for December for the US dollar due to tax reasons. Now, looking at the S&P, it's slightly less attractive because we have that historical downside and then followed by that upside if we detrend the data. But according to ANZ Investment Bank, that Santa rally at the backside of December normally has a positive hit rate of about 77% and a median monthly return of about 1.3%. So looking at the detrended chart, we could see some early December downside followed by that typical Santa rally as we head towards the end of the year. But something also to keep in mind here is volatility, or at least implied volatility in the form of the VIX. Now, out of the past 2 decades, the VIX usually creeps higher in December. And that isn't due to some magical thing that's happening in December. What we normally have in December is the festive period, right? So lots of traders are away from their desks, they're taking off some time, and that means thinner liquidity and lower volumes. So, on its own, arguably it doesn't mean much, but looking at everything in context, once again, in terms of where we are with these trends going into December, December would be a very ideal time, so to speak, to expect a little bit of a short-term buckle in some of these trends. Now, the other factor to keep in mind is the forward-looking nature of the market. With all of the expectations going into 2021, one has to assume that a lot of the positive news has already been priced in. Well, that is true and also not true at the same time. I mean, if you take a look at the market's forward-looking nature, it does mean that a lot of good news for equities and a lot of bad news for the dollar has been priced in. But if you take a look at this chart below, this is basically the dollar index in the blue versus a very simple equal weighted measure that we just created in TradingView. And that shows that the drop in the US dollar and what we're seeing right now might just be the start, with many investment banks right now calling for a new secular downtrend starting in the US dollar. So if that is the case, then what we've seen for equity so far and what we've seen for the dollar so far might just be the start, especially in the medium term. And that is certainly the consensus view right now in the market. However, various indicators such as the put-call ratio that we discussed, as well as insider selling on the corporate side, as well as various greed and fear sentiment gauges from various investment banks are all showing a lot of complacency on the equity side right now. Now, what does that have to do with the US dollar? Well, remember that strong equity sell-offs are usually accompanied, as we can see on this chart as well, in June and September, are usually accompanied by some support for the US dollar from that safe haven as well as that reserve currency point of view. And if we just take a look at this recent chart below from a Bloomberg report, we can see that once again asset managers have increased their net short bets on the greenback to record low levels. Now, does that mean that we just go selling equities and buying the US dollar from Monday? Well, of course not. Unless, of course, you like the pain associated with trying to catch a falling knife. That's not what we're saying. What we're saying right here is that the market's current overarching biases remains firmly intact going into 2021, but trying to chase these moves, arguably overextended moves in the short term, doesn't really look that attractive given all of the information that we've shared above. So let's look at what might tip the scale in either end in the week ahead. There's plenty to be focused on in the week ahead, and a couple of important events, all of which could act as potential triggers to push the market further in line with those overarching themes and biases, or it can also be events that creates a little bit of additional volatility that might see some mean reversion finally kicking in. Now, firstly, US stimulus. Yes, the saga is back in focus, and there's been some progress made apparently on a $900 billion bipartisan stimulus bill, which apparently includes well-needed extensions to both unemployment benefits as well as support for small enterprises. Now, any agreement in the week ahead could add further momentum to the upside for risk assets and pressure the US dollar. Also keep in mind that on the political side, a US side, we do have the budget deal discussion still ongoing, and that could be linked according to sources, to a short-term stimulus relief bill. But if there's no agreement reached by Friday, we might be moving towards a government shutdown in the weekend, in the US towards the weekend, which won't be positive for risk assets. Also considering vaccine news on Thursday, we have the FDA that needs to decide whether they will approve the Pfizer and BioNTech coronavirus vaccine. And approval will arguably still be very positive for markets, even though lots of vaccine optimism has already been priced in. Then turning to the ECB, we've got a long-awaited meeting in December. Markets are very clear in terms of what they're expecting from the ECB. They're expecting rates to stay unchanged, but they are expecting the ECB to increase the size of the PEP with 500 billion euros and also introduce more favorable conditions and terms for the TLTROs. Then also Brexit, right? We are in the last stretch, and yes, I admit that we've been saying that we are in the last stretch over the last couple of weeks already. But with this week's EU summit taking place on Thursday and Friday, this really is down to the very last stretch right now. But obviously that is still left to be seen whether we get a deal or not. Now, a deal is closer than ever right now, according to sources at least. And markets have been continuously pricing in the possibility of a deal, especially this past week with the pound climbing across the board. Now, a deal or a no deal outcome, obviously this week, will be very important for risk assets either way, and an important one to watch, especially if the possibility, of a buy the rumor and sell the fact reaction plays out in the pound. We did talk a lot about that on the videos that we did on Friday, as well as the webinar on the terminal. So do make sure to check those out for more information. So looking at the week ahead, then the trade plan is going to be very simple, guys. The trends, like we said, for 2021 are firmly baked into the market consensus right now for equities and the US dollar. So any good news on multiple fronts should provide a further boost in line with those trends, whereas bad news on multiple fronts could be the catalyst that creates a little bit of an overdue, in my opinion, short-term correction in some of those trends. So scenario one, more good news versus bad news. Now, some good news would include, like we said, a breakthrough on US stimulus discussions and also avoiding a government shutdown. Secondly, an approval from the FDA on that Pfizer vaccine. Thirdly, a less dovish ECB. That'll be bad for the US dollar. And then fourthly, a Brexit deal before the EU summit. Now, in this scenario, we would expect to see, firstly, upside in equities across the board, with US equities expected to gain more ground if we see developments on the US side, like the stimulus breakthroughs and avoiding a government shutdown. And we'll arguably see more upside on the EU equity side if we see a breakthrough in the Brexit deal. But a less dovish ECB, if we do get that, that'll be a negative for the dollar. But it can actually create some downside on the EU equity side. So definitely want to watch just a caveat there. And then in all of the above, expecting downside across the board for the US dollar. Second scenario would be more bad news than good news. Bad news includes a breakdown in US stimulus talks, a possible government shutdown, the FDA rejecting the Pfizer vaccine or maybe just postponing the approval of it. Thirdly, a more dovish ECB, which cuts interest rates, and then a complete breakdown in Brexit talks with no deal by the EU summit. Now, in that scenario, we would expect to see downside in equities across the board. Again, focus on the US equity side if we see stimulus talks collapse, as well as a government shutdown or moving towards a government shutdown. And we'll obviously expect to see more downside on the EU equity side if we see Brexit talks collapse. But, like we said, a more dovish ECB with potential rate cuts. That'll be negative for the euro, which will be positive for the dollar, but it will also be more positive for EU equities because it means more stimulus, obviously lower for longer in terms of narratives. And then we will expect upside in the US dollar across the board as well.